Hello and welcome to Explain the Charts. Today is Monday, October 13th, 2025, and we are diving deep into Alphabet, ticker symbol Google. The stock is currently trading around $241, showing a positive start to the week after a volatile end to the last one. There has been a tremendous amount of news surrounding Google recently, creating both bullish and bearish arguments. On the bullish side, the company recently hit a new 52-week high of $256, propelling it into the exclusive $3 trillion market cap club. Much of this optimism, as noted by Wedbush, stems from a significantly improved consumer sentiment backdrop and excitement around Google's AI initiatives. Analysts are taking note, with firms like Citi raising their price target to an ambitious $280, citing expectations for significant Gemini AI adoption across its advertising and cloud businesses. However, it's not all clear skies. There are significant headwinds to consider. Last week, the broader tech market, including the Nasdaq, took a hit after President Trump threatened a massive increase in tariffs, showing how sensitive Google is to geopolitical news. Furthermore, regulatory pressure is mounting. Britain's antitrust watchdog has designated Google with strategic market status, which could lead to stricter regulations, and the EU is demanding explanations on measures to protect children online. These competing narratives of strong business growth versus regulatory and political risk are what's creating the fascinating price action we see on the charts. Now, let's look at the daily chart to see how this has all played out over the long term. We can clearly see a powerful uptrend that began in early April of this year, when the stock bottomed out near the $140 level. From there, it was a steady climb, breaking through previous resistance around the $190 mark in early July. After that breakout, we saw a pullback and consolidation period through late July and August, where the price established a solid support base in the $155 to $160 range. The real fireworks started in early September. On September 3rd, the stock gapped up massively, jumping from around $211 to over $230 in a single day. This move was on enormous volume and signaled an immense wave of buying pressure, likely tied to the news of it joining the $3 trillion club. That explosive move carried the stock all the way up to its new all-time high of $256 on September 19th. This $256 level is now the most critical resistance level for bulls to overcome. Let's zoom in on the price action since the beginning of July to get a better feel for this recent surge and subsequent pullback. After hitting that $256 peak, the stock has entered a corrective phase. Over the past few weeks, we've seen it establish a new support zone, roughly between $235 and $240. Notice this large red candle on October 10th. The stock closed down over 2% that day at $236.57. This drop coincided directly with those tariff threats we mentioned earlier, highlighting the market's skittishness. The price has since bounced from that low, which is a constructive sign. The key question now is whether this current price action is simply a healthy consolidation before the next leg up, or if it's the start of a more significant correction. The battle between the long-term uptrend and the recent selling pressure is on full display here. To get more granular, let's switch over to the 1-hour chart and look at the last couple of weeks. This view clearly defines our current trading range. We have clear short-term resistance established in the $245 to $246 area, a level that has rejected upward moves multiple times. On the downside, the support is very clear at the $236 low from October 10th. For the past two trading sessions, the price has been coiling within this roughly $10 range. From a short-term trading perspective, a decisive break and hold above $246 would be a bullish signal. Such a move could see the price quickly target the psychological $250 level as its next stop. Conversely, if sellers take control and we see a break below the $236 support, the outlook becomes more bearish in the short term. A breakdown here would open up the possibility of a move down to the next support level near $230. Finally, Let's zoom into the 15-minute chart to analyze the intraday action from the last trading session on Friday, October 10th. This really shows the impact of the negative tariff news. The price experienced a sharp sell-off in the afternoon, plunging from the $242 level all the way down to that critical low of $235.84. Although there was a minor bounce attempt into the close, the session ended on a weak note, near the lows of the day. This indicated that sellers were firmly in control heading into the weekend. However, based on today's pre-market data showing a price of $241.40, we've had a significant gap up this morning. This is a very bullish short-term sign, suggesting a complete reversal of Friday's negative sentiment. This gap is likely a reaction to the weekend news headline about rising hopes that a trade war can be avoided. All right, let's switch back to the daily chart to recap and look ahead. The key levels to watch are crystal clear. Major resistance is the all-time high at $256. Minor, but immediate, resistance is at the $245 to $246 zone. On the support side, the current major support zone is $235 to $240, with last week's low of $236 being the crucial line in the sand. If that fails, the next major support is the top of that massive gap up from early September, right around $212. So, what are the likely scenarios? I believe the bullish scenario has about a 65% probability right now. In this case, the stock holds above the $240 level, driven by today's positive momentum, and breaks through the $246 resistance. This would be reinforced by any positive news regarding trade talks or a dovish stance from the upcoming FOMC meeting. A successful breakout would target $250 and then the all-time high of $256. A more bearish scenario, which I'd place at a 35% probability, would see the stock fail at the $246 resistance and fall back to break below $236. This would likely be triggered by a renewal of tariff fears or unexpectedly hawkish Fed commentary. A break below $236 would signal a deeper correction is underway, with the first major target being the gap fill down at $212. Keep a close eye on trade headlines and central bank commentary, as these macro factors are clearly influencing the price action. That's our in-depth look at Google. As always, this is for informational purposes only and is not financial advice. You should always conduct your own research and due diligence before making any investment decisions. Thanks for watching Explain the Charts.